Hello, we are Team 5, and today we will be talking about American Express and its inclusion in the Nest Fund.
I'm going to start us off by going through the key points we'll be presenting. We'll be focusing on financial health, ESG practices, and business strategy. By the end, we'll see how well American Express aligns with Nest goals and objectives. American Express is a global payments company known for their strong brand, innovative financial services, and prestige line of customers. American Express is recognized for its commitment to corporate responsibility efforts, aligned with a growing demand for responsible investing, which we'll explore in further detail later on. The National Employment Saving Trust, or NEST, was established through the UK Pensions Act in 2008. Its mission is to provide secure retirement for all members through responsible and sustainable investment. NEST invests similar proportions into fixed income and equity. The rest of the portfolio is mainly property-based investments. NEST also teamed up with UBS to manage over 40% of its portfolio via the GBP-hedged UBS Nest Climate Aware World Equity Strategy.
First, we will start by addressing Amex's financial health. To do so, we will compare its current and historical performance with that of its closest competitors, such as Visa, MasterCard, and PayPal. Where applicable, we will also compare Amex's performance to a major tech index, the Nasdaq Composite, and to the UBS equity strategy mentioned earlier. Amex's financials are particularly strong when it comes to revenue growth, long-term net income, and EPS growth. Amex has the highest revenue among its close competitors and the largest cash and quick ratio on its balance sheet. Amex shares still have an attractive price-to-earnings ratio, even though the recent high momentum in share price increase. Amex's weaknesses include low returns on assets, low profit margins, and high leverage, including low times interest earned ratio and a debt-to-revenue ratio of 4. Risks include a long average collection period of 1 year, a severe 2% net write-off rate for bad debt, and heavy ownership concentration with 3 entities owning 1/3 of Amex shares. As shown on the chart on the top, Amex leads the 5-year cumulative share price return, followed by Nasdaq and the UBS fund. UBS Equity Fund is the least risky with 50% lower maximum drawdown and volatility than Amex. Visa is the leader in terms of Sharpe ratio. Additionally, it has a high alpha low beta profile, making it attractive for maximizing return and diversification. Amex has seen recent positive trends. It has just reported its 10th consecutive quarter of record revenue and has seen 9% year-on-year increase in client credit card spending. However, Amex's bad debt more than doubled in the last year, and the net write-off rate on receivables grew 7 times in the last 2 years. On the flip side, Amex returned $5.3 billion to shareholders recently via share repurchases and dividends. As dividend payments provide stable return even in economic downturns, this is crucial for Nest. Amex's dividend yield of 1.27% is the highest among competitors and is respectable even when compared to dividend aristocrats. American Express has a good credit rating, regardless of its high leverage and low interest cover. Moody's and S&P gave Amex the second best credit rating possible. In addition, 21% of analysts strongly recommend buying Amex. At the same time, more than 30% recommend the same for Visa and PayPal.
Next, we'll evaluate American Express's ESG strategy, which covers 3 main pillars: environmental commitment, social impact, and governance standards. First, American Express has a well-structured ESG approach with oversight from its strong, diverse executive and board committees and regular stakeholder engagement to ensure it aligns with regulatory standards and stakeholder priorities. The ESG framework embodies 3 main pillars, which we'll discuss in the next few slides. In the first pillar, financial confidence, Amex's objective is to promote resilience in underserved communities. They've achieved $100 billion in shop small spending and opened 3.1 million new credit accounts for underrepresented groups, advancing their 2025 goal with some further key metrics listed here about their ongoing, in progress, and achieved goals. On the environmental front, Amex has committed to achieving net zero across its value chain by 2050, implementing climate risk management and advancing carbon tracking technology. In social impact, Amex aims to drive financial confidence in communities, supporting small businesses with financial access and education and achieving global pay equity. The chart on the right illustrates the statistics on their workforce demographics, emphasizing their diversity. In governance, Amex's strong ethical standards and transparency in reporting contribute to its great ratings, such as an 18.7 in Sustainalytics and others referenced in the chart above. While Amex has encountered challenges such as data privacy breaches and labor practice concerns, the list above highlights potential criticisms pension fund investors may look out for. In summary, American Express's ESG commitment aligns with sustainable and resilient investment goals, making it an appealing candidate for ethical long-term portfolios.
Long-term business strategy. American Express operates in multiple sectors, each supported by a tailored strategy aimed at sustained growth for the next 30 years. This is based on adding value to their premium members by offering exclusive rewards. They are looking to differentiate themselves through innovative and seamless integration into enterprise systems by offering financing, banking, and payment services. They will continue leveraging their closed-loop network, meaning that they have direct relationships with both cardholders and merchants. And lastly, they will continue to invest in AI-driven security and data analytics. Examples include its Agile Partnerships platform with fintechs and its multi-factor authentication tool called SafeKey.
This slide outlines the comparisons between MX competitors and their various business models and strategies, where MX leverages on its multiple revenue channels, annual fee, interest, and card balances, and merchant discount fees, whereas Visa and MasterCard's main revenue source is transaction processing fee. MX digital strategy focuses on customer experience, AI-driven personalization, and fraud protection, wherein Visa focus on infrastructure innovation and MasterCard focus on payment processing innovation. Talking about opportunities and risks of MX. MX offers integrated expense management tools and flexible financing options to attract and retain business clients, supporting steadier cash inflows and enhancing corporate loyalty. Fintechs offering buy now pay later and digital loans threaten MX credit products, whereas Planet and paid feature of MX offers flexible financing and payment options combat this digital loan risk. Despite lower customer volume compared to Visa and MasterCard, MX combats this by focusing on premium loyal customers and high margin services, emphasizing value added benefits to retain and grow its customer base.
So, should pension funds swipe right on MX? Despite challenges like raising bad debt, data privacy concerns, and intense competition, we believe the benefits, like including brand value, attractive share price, increasing revenues, growing spending from premium clients, and good management, outweigh the risks, supporting our recommendation to include Amex in Nest's equity portfolio. Thank you.